Welcome back. Today, we're going to talk about inventory costing. So, inventory costing is basically how a company determines the value to report, the value to measure inventory at when it reports it on the financial statements. So, I'm separating out inventory costing from inventory valuation. When we talk about inventory costing, it's determining how do we determine the cost of the inventory. And that is generally what gets put on the financial statements as the measured value of inventory. I'm separating that out from the valuation of inventory. So once we determine the cost of inventory, I'm going to talk about valuation of inventory a little bit differently, because the value is the idea that, well, we report inventory at the lower of cost or net realizable value. So under that notion, the first step is, well, what is the cost of the inventory? And that's what we're going to talk about when we talk about LIFO, FIFO, weighted average costing, what costs go into inventory itself. That is going to be the costing of inventory. I'm dealing with that separately from net realizable value. Now, if the net realizable value of inventory changes, that is also going to change what we report on the financial statements, but that is not the cost per se. So most of what we're talking about right now is going to be costing of inventory. So we're going to start with understanding inventory classifications and different inventory systems. So their inventories are an asset. They are items held for sale in the ordinary course of business or goods to be used in the production of goods to be sold. So inventory includes both the stuff that we're actually going to sell as the stuff we're going to use to make the stuff that we sell. And those are in terms of goods used in the production. Now, that's not fixed assets. Those are very different. But if it takes, say, some type of lubricant to mill, to run things through your mill, then that lubricant is considered part of your inventory because it's going into the production, or it is basically a byproduct or a intermediate product as part of the production. So that is inventory. Inventory is classified as a current asset on the financial statements. It's typically the third asset listed if a company even has inventory. You have cash, receivables. The next thing is inventory, with the notion that the operating cycle is you buy inventory, so cash goes out, you buy inventory, you then sell the inventory, you get an accounts receivable, then you collect your accounts receivable and you get cash. That's kind of the operating cycle. So that's inventory is typically the third asset listed in terms of liquidity on the balance sheet. Companies who have inventories, typically merchandisers, so retail companies, Walmart, Amazon, they have inventory that sits on their books, or manufacturers who produce goods that then they sell oftentimes to retailers or to merchandisers. Inventory can be listed as, say, one account where you just say inventory is whatever. It can also be broken out into other specific items of inventory. Now, manufacturers, you'll see this a lot. They'll break out inventory between raw materials, work in process, and finished goods. Raw materials being the stuff that they have, their raw materials, so what they buy from wherever they get it. Work in process being what is actually basically under construction right now, and then finished goods are the stuff that they have available to sell directly to consumers or to other retailers or whoever their end buyer is. So that's typically how manufacturers end up breaking it out. You'll also see any number of ways even retailers will break out their inventory between types of inventory. Again, the classifications of inventory are largely going to be driven by what investors are looking for, what information is valuable to them in terms of analyzing the future profitability of the company, and whether a classification of inventory makes sense or whether investors are like, just knowing you have the inventory is all we need to know. So that is typically how it is classified. The general process. So in creating your inventory, so what ends up in inventory is more than just the raw materials, to phrase it a little bit differently. So to produce something, so we're take a manufacturer, for instance. So a manufacturer, and we're going to manufacture, I don't know, fishing reels, since I enjoy fishing, and we're going to talk about fishing reels today. So if we want to manufacture fishing reels, to manufacture a fishing reel, I need some metal, plastic, any number of bolts and nuts, and then depending on how far along I'm, whether I'm just constructing it or whether I'm actually manufacturing the materials that go into it. So basically some combination of metal and parts. I also need people who are going to put their time into the manufacturing process, and I need machinery and a building for them to do it in. All of those costs go into inventory. That means the raw materials, which is the metal and the plastic that goes into the fishing reel, that's going to be inventory. The labor costs associated with producing a finished product or a finished good, those labor costs are going to go into inventory. And then all the overhead, the cost of the machines, the cost of the building, all the production costs also go into inventory. It's not just the raw materials. So there is depreciation expense, well, it's not expense yet. There is depreciation that sits in inventory in a manufacturing company. It's the depreciation on the equipment used to produce the goods that they're selling. Those are sitting in inventory until the inventory item is sold. So that depreciation gets allocated a little bit to every single product. So every single time I build a fishing reel, there's a little bit of depreciation that's going to go into that reel. And when that reel is sitting in inventory, so is the little bit of depreciation that's attached to that reel. When I sell that, then I actually expense, let's call it through cost of goods sold, I expense that piece of depreciation and the labor that went into making that reel. And all of those costs are going to be put into the value of that reel or the value of that inventory until it's sold. And then those costs are going to flow out of inventory into cost of goods sold for the period. So those are all the costs that go in. There are two broad inventory systems, inventory accounting systems. There is a perpetual system and a periodic system. We will spend almost our entire time talking about a periodic inventory system. But it's not the only one that's out there. There is a perpetual system. Anymore, I have never met a company that uses a perpetual inventory system from an accounting standpoint. Now, I separate that from what might look like a perpetual system in the fact that they're constantly tracking their inventory. Anymore, everybody constantly tracks their inventory, but that's not how they account for it. They treat that perpetual system as a means for an input into their periodic inventory system from an accounting system standpoint. So I will refer to that more from a standpoint of that is their real-time inventory system. It does not mean it is a perpetual accounting system. And you'll see how the entries are actually quite a bit different under these two systems. So in a perpetual system, when you buy merchandise, it is put into inventory. So you buy merchandise, you credit whatever accounts payable, and you debit inventory. When the freight costs go into inventory, everything goes into the inventory account itself, and it's sitting in the inventory account. Then every time we sell something, we take it out of inventory. So for every sale, we debit cost of goods sold and we credit inventory. So we're taking it out of inventory and sending it through cost of goods sold. And we do that every single time a transaction happens. So our inventory account is basically a big flow account, which has stuff flowing into it and flowing out of it in the accounting records. Now, that is a perpetual inventory system. So in a perpetual system, our debits and credits are to inventory and to cost of goods sold every time there's a transaction. Every time we buy inventory, every time we sell inventory, or every time we buy inventory and every time we make a sale, there is the transaction that captures that in the inventory account. Now, I'm going to separate that out from a periodic system. A periodic system is essentially every time I audited a company, I have only ever seen a periodic system. Even though these companies almost universally anymore, these companies have an inventory control system that tracks all their inventory. So at any point in time, they can tell you how much inventory they should have in the warehouse of all the different parts and where it's located. So at any point in time, they can tell you that information, but that doesn't mean they're updating their inventory account. So that's the big difference here. They don't update the inventory account until the end of the period. On an accounting perspective, they have a inventory control system that tracks inventory on a perpetual basis, but that's different than an perpetual accounting inventory system. So in the periodic system, we have purchases we add a purchases account. So purchases, when we buy goods, we debit purchases and credit whatever they call accounts payable, for instance. So all of our purchases sit in this purchases account during the period. When we make a sale, we aren't updating the inventory records every time we make a sale. We just make the sale side. We do not make the cost of goods sold entry for every sale. Instead, we make the cost of goods sold entry at the end of the period. Most companies do this at the end of the month, but with systems these days, a lot of times they can link their inventory control system into their accounting records and basically kind of do this at any point in time if they need a report, for instance. So in a periodic system, we only periodically update the inventory account. We update the inventory account whenever we essentially at the end of the period for our safety purposes, because we're talking about financial reporting, which is done at the end of the period. We're going to run a report. We're going to update inventory at the end of the period. And how we do that is we update the inventory account by saying, okay, well, how much value do I have in my inventory account now? And I use that to back into what the cost of goods sold is for the period. So the way this ends up working out, we calculate under the periodic system, we calculate the cost of goods sold. So we start with beginning inventory. We then take our purchases for the period, which are tracked in a separate purchases account. We add purchases to beginning inventory. That gives us our goods available for sale. The goods available for sale is critical. I will say in general, this calculation is critical. You will see this come up over and over and over and over again. Without knowing this calculation, you're going to get lost a lot. This is a very straightforward calculation. Step one, we need to know how much did we have available to sell this period. To do that, we take our beginning plus our purchases. That tells us how much could we have even sold this period. That gives us our goods available for sale. And then, once we have our goods available for sale, we subtract out our ending inventory. So what's sitting in our inventory right now? So we take what we had available for sale, we take out what's left, i.e. what has not sold, and that gives us our cost of goods sold for the period. That is the periodic system. Now, that ending inventory number for say your end of year statement, that's going to come from a physical count. So people are going to go into a warehouse. They're going to count all the goods in the warehouse, figure out what the cost of that inventory sitting in the warehouse is. That's going to be your ending inventory value. Now, on a more frequent basis, say monthly or even quarterly, the company may rely on its inventory control system to tell you what their ending inventory is at the end of, say, a month. Say we'll take August, since it's not a quarter end for most companies. We want to run a report for August. We're just going to go into our inventory control system. What does it say our ending inventory is on August 31st? And we're going to plug that into ending inventory to give us cost of goods sold for that same period. So under a periodic system, purchases of merchandise are debited to purchases, not the inventory account themselves. And ending inventory is determined by a physical count or the inventory control system, depending on kind of what you're doing here. And then you calculate cost of goods sold using the formula that we just walked through. So that is a periodic system. That is predominantly what we will be using as we work through this entire chapter. This notion that we figure out what the ending inventory, we figure out what inventory is, and then that gives us what the cost of goods sold is for the period. Okay, to compare the perpetual and the periodic inventory systems, we're going to walk through this example. So in this case, this company, they have beginning inventory valued at $600. Then they have purchases of 900 units at $6, which would bring their goods available for sale up, or their purchases to $5,400. They have sales of $7,200, and they have ending inventory 400 units at $6, again, because all their purchases and their beginning inventory were all at $6. So their ending inventory is worth $2,400. So how's that end up working out? So under a perpetual system, beginning, we both start the same, periodic and perpetual. We start at the same place. There's $600 of inventory. Now, they purchased 900 units at $6. Now, under the perpetual system, we are going to debit inventory and credit accounts payable for the cost of that, which is $5,400. Then when we make the sale, we are going to record the sale itself. So the $7,200 debit to AR, credit to sales. And we are also going to show the inventory being sold. So we are going to debit cost of goods sold and credit inventory for the cost of the inventory that was sold. Now, at the end of the period, there's essentially nothing that we need to do. We already know what the ending inventory is because we already tracked it in our accounting records right there when we sold when we sold the inventory. Now, under a periodic system, that changes. The purchase stays the same. We still purchase the goods for $5,400. So, but instead of going to inventory like it did under the perpetual system, under the periodic system, it goes into purchases. So we're going to debit purchases and credit accounts payable. Now, when we make a sale, we just record the sale. Under the periodic system, we only record the sales side. We aren't recording the inventory side of this at this point in the process. This is the big difference between the periodic and the perpetual system. It separates the inventory from the sales, or it separates cost of goods from the sales transaction. So in that sense, it greatly simplifies the accounting because you don't have to have an inventory, a record, or an inventory transaction every time you make a sale. So when the sale is made, all we do is record the sale. We don't do anything with inventory or cost of goods sold. Now, at the end of the period, we're going to count our inventory or use whatever our system to tell us what our ending inventory is. We use that to record the following transaction where we debit inventory for $2,400. That's going to be our actual ending inventory amount. Now, you can combine this with our beginning inventory transaction or credit, which is in the same example here, but typically those are combined. So essentially you're debiting inventory for $1,800. You're debiting cost of goods sold for the $3,600, and then you're crediting purchases. So you're taking the inventory or the costs out of purchases, and you're applying that plus the beginning inventory to your inventory and your cost of goods sold accounts at the end of the period. But you're only doing that at the end of the period, or you're only doing that periodically as opposed to doing it perpetually under the perpetual system. Now, under a perpetual system, they still do a physical count. And despite everyone's best efforts, you end up with differences between what your perpetual records show and what your ending inventory count is. For instance, if someone forgot to record a transaction, however that happened, if someone walked off with some of your merchandise, or a sale got rung up incorrectly, they forgot to ring up something, or they rung up something twice, all of those are going to cause problems or differences in what you're recording perpetually as your inventory and what it actually is at the end of the period. So regardless of their inventory system, all companies do a physical count of their inventory, usually at least once a year. Under GAAP, I think they're required to do it once a year. So they do this count, and inevitably they're going to be off by some amount. In this case, we have an example here where they're off by $200. Well, that $200 needed to get taken out of inventory. So they record it through an inventory short and over account. That is a debit to inventory short and over. That is a cost of goods sold account. So that amount still ends up in cost of goods sold. It doesn't just go away. And then they reduce inventory to what it actually is. So regardless of your method, your inventory at the end of the period needs to actually match up to the inventory you have on hand at the end of the period. And everything else needs to go into costs of goods sold because those are costs of goods sold. Now, if there was some big catastrophic event, it's possible the company could pull that amount out and not put it in the cost of goods sold, but separate it out into a different line item, which would just tell investors that don't expect this is not a normal costing event. This is something that needs to be separated out. So going forward, so they would report it separately, so they could separate it out going forward. Now, as I mentioned, all companies have to periodically verify their inventory. They do that by actually counting it, and they compare the count to what their inventory control systems say it is, and they update those for the count of the inventory. A lot of companies anymore are doing essentially rolling counts, where they're counting a little bit of inventory all the time, and so that they count everything once every, say, 3 months. So they'll have these rolling counts. Instead of having to shut the warehouse down and do one full physical inventory count of everything at the same time, they'll do these rolling counts. So now determining cost of goods sold. We already worked through the periodic calculation. So companies have to allocate all the costs of the inventory to cost of goods sold when it is sold. They do that in a periodic system by doing this basic calculation where you have beginning inventory plus the purchases gives you the goods available for sale or the cost of the goods available for sale. You then take out whatever's left, and that gives you the cost of goods sold during that period of time, i.e., if that this is what we could have sold had we sold everything. We didn't sell this amount, that's still sitting in inventory. So then obviously everything that's left or anything not sitting in inventory was a cost that we allocate to the sales for the period. Now, which goods and costs are included in inventory? So goods and inventory, we already talked about materials, labor, overhead, all of that ends up in inventory. But a company recognizes inventory and accounts payable at the time it controls the asset. That does not necessarily mean that it has possession of it. And it doesn't even it's totally not tied to possession. There's inventory companies have that they don't possess. And there's also inventory or items that they possess that aren't in their inventory. So then it gets to the question of, what do they possess? Well, first of all, stuff that may be their inventory and not sitting on hand. One, we have transportation stuff. So depending on transit terms, FOB, shipping point, or destination determines when you take ownership of it. Is it before it gets, is it at the time it gets shipped out, or is it at the time it arrives at your door? Well, that's important to know, especially if the company has a lot of inventory sitting in transit. So I audited essentially a smelter who purchased raw materials, which in this case was essentially zinc, raw zinc, so extracted from mines, and a lot of it was shipped from Australia. So it was shipped from Australia, and a lot was in transit at any point in time. So where they took ownership or where they took possession of that actually mattered to their inventory. Whether they took possession of it at the time it left the port in Australia. A lot of times they took ownership of it almost as soon as it left the mine in Australia. And they had possession and ownership the whole way across the ocean to the point where it got dumped into the dock facility where it was staged in New Orleans before being barged up the Mississippi River. So we had inventory at all these locations that we audited to make sure that it was actually there. And there's a number of different ways we could do that. Part of it was verifying it with, say, the storage facility in New Orleans, that they actually did have a big pile of zinc dirt sitting in their facility for our client. So in that case, the goods in transit and when they took ownership actually really did matter. If you're just dealing with they're shipping it from the other side of town or something, that's usually a very small number. It doesn't usually make a big difference. So that's a situation where goods that that are yours, inventory, you may not even have technically physical possession of, at least in your warehouse. There's also consigned goods, which can go either way. I can consign my goods to somebody else. So let's say I'm selling, garden equipment, and I sell it through Walmart. And Walmart doesn't want to actually buy my garden equipment and then resell it because it has to get rid of it all every fall and put up Christmas decorations. So what they do is I consign it. So I provide Walmart all of my garden equipment that they put on their shelves to try to sell. They take a big cut of that, but it is still my inventory. And at the end of the season, so sometime in mid-September, Walmart calls me up and says, this inventory is still sitting on the shelves. It needs to be gone in the next week. Get it out of our stores. We need to put Christmas decorations there. Well, it's my inventory, even though it's sitting in Walmart stores. Walmart and even Amazon, a lot of the inventory sitting in their stores or their warehouses isn't their inventory. It's other people's inventory that they are selling. And they facilitate that by taking possession of it so that when I go to Walmart, I don't have to put in an order for a packet of seeds. I can actually pick them up right there. It's very convenient for me. And then on the Amazon side, Amazon is warehousing a lot of other sellers' goods so that when I put in an order to Amazon, Amazon can fulfill that through their own warehousing distribution network and system. It speeds up the process, makes it more convenient to me. So in those cases, those goods are consigned. So when I consign my stuff to Walmart, it does not end up on Walmart's inventory account. It's my inventory. Just because it's sitting at Walmart doesn't mean it's Walmart's inventory. So those are consigned goods. Now, there can be the other case, and this actually starts getting really fuzzy, is if I'm a manufacturer, I can have goods that I haven't shipped yet that I have technically sold, but there is this is an area that is ripe for fraud. So it is actually a big, there are a lot of accounting standards about when you can and can't do this, because the idea is, well, one way of juicing my income is basically saying, well, I know they're going to buy it, so I'll record the sale now, even though I'm not going to ship it for another month. Well, that's a little problematic because you actually haven't shipped it. So if you want to basically, if you have goods that you have already sold and they are not yours, and are sitting in your warehouse and you're trying to record the sale, those goods actually have to be fully segregated, and the risk of loss has to have passed to the customer. So you really have to be doing that for the benefit of the customer. Otherwise, they're not going to agree to it. They're going to be like, well, whatever, I don't need them until next month. Send them to me next month. In the meantime, you keep them. So those are consigned goods, or essentially kind of sales of goods where shipping just hasn't quite happened yet. There can also be sales with repurchase agreements. Really, this is kind of like a souped up version of a consignment where, well, maybe Walmart will pay me for all the merchandise I'm going to put on their shelves, but I have to buy it all back from them in September when they want their shelves emptied out. So that is one case that is treated the same way in accounting. If there is a repurchase agreement, that typically does not count as inventory. So sales with repurchase agreements, they're often referred to as repurchase or product financing arrangements, and they usually involve the transfer of sale with either an implicit or an explicit repurchase agreement. So these arrangements are often described in practice as parking transactions. So I am parking it, which means it will be moved. So you can't recognize revenue when you have a parking transaction, and similarly, the inventory shouldn't be passing. So these are situations that really should get treated like a consignment from an accounting standpoint, despite there maybe even being invoices or the like. So that wraps up the general discussion. Next, we're going to talk about the cost flow assumptions, and this is our LIFO, FIFO weighted average costing. So I'm going to take a quick break here, chop some more wood, and we'll get back and do this here in a second.